Wen Yi is a principal and consulting actuary based in Singapore. She has over 20 years of experience in the life insurance industry and has led a variety of life insurance projects. Her experience includes providing appointed actuary services, leading mergers and acquisitions, projects across Asia, assisting companies in the life implementation, and optimization of capital with the introduction of new capital regimes, product pricing and development, and advisory work around the management of participating business. She will chair this panel. We will have Clara Yan on this panel, as well as Kim Rosenkilde and David Chua. Now, Wen Yi, I forgot, will you be introducing the panelists or will I be doing that?
Yes, I can do that. Thanks, Andres.
All right, so let me, right then. So please join me in welcoming this panel, the panelists and the panel chair. Over to you.
Thanks, Andres. So I'm very pleased and excited to introduce our panelists for this session. So to me, they are all practitioners in this area, and I do look forward to hearing from them, their views and opinions on what sustainable investment means. So first we have Kim Rosenkilde, who's the CIO of Singlife. So Kim leads the investment management activities at Singlife and is also chairman of Navigator Investment Services Limited. Kim has previously held senior executive roles with ICAP, Deutsche Bank, and ABN AMRO Bank in London, New York, Tokyo, and Shanghai. Kim holds an ESG Competent Board Designation Program certification, has an advanced management program with Harvard Business School and investment management program from London Business School. So next we have David Chua, who's the CIO of Income Insurance. So David joined Income in 2023 and is a member of the executive committee. He's an experienced investment manager with over 20 years of capital markets and portfolio management experience with prior track record with Prudential, Munich Re, Goldman Sachs, Nomura, and SCB. So David is a CFA charter holder and holds a clear grasp of macro trends and proven track record of delivering investment returns for financial institutions. So last but not least, we have a fellow actuary, Clara Yan. So I'll still quickly introduce you to Clara for those who missed the earlier presentation. So Clara is based in the UK and is the head of insurance solutions at Robeco, where she develops insurance analytics and advises insurance clients on asset allocation, capital management, accounting, regulatory, and asset liability modeling. Clara actively collaborates with insurers to integrate sustainability analytics into their portfolio construction process. Clara joins from Schroders and previously worked at UBS and Legal & General Investment Management. So Clara is a fellow of the Institute of Actuaries and a CFA charter holder. So before we commence our discussions, I would also like to recommend that you listen to a speech that our senior minister, Taman, made as keynote speaker at the Eco Prosperity Week held a couple of weeks back. So the topic is around governance and policy making in respect of sustainability and should resonate with well with the topic that we are discussing today. So the speech is saved on LinkedIn. And please reach out to the SAS organizing committee who will share the links to this speech. So for this panel session, I have 4 questions in total. I'll assign around 30 minutes for this question and then leave the 5 minutes for Q&A from the audience. So the first question I have for the panelists is just to get an understanding of sustainable investments. So what is sustainable investments and how has it evolved? Maybe I can start with one, Kim.
I will gladly go first, but it's always ladies first, Clara. So if you want to go, then I'll gladly wait for that as well.
I feel like I've already kind of covered that question in my earlier presentation. So I'll let you guys go first as well, and happy to comment on it.
And actually, the answer that I have prepared is one that will probably demonstrate that I, like many other allocators or investment managers, frankly, don't quite know yet. The sustainable investment industry, if you want to call it that, has been around for quite a while in Europe. A lot of it at the time of beginning, such as offshore wind and even photovoltaic, was often more a question of getting some form of energy supply that wasn't dependent either on an oil price, or it wasn't dependent on a US dollar price, or vulnerable to a volatility in commodities pricing, a dollar, and so forth. So at the time, I will assure you that it was more a focus on G than E and S. There was always a very early understanding of what governments meant in terms of efficiency of management and also on returns for the companies. And unfortunately, I'm so old that I actually remember that Gro Harlem Brundtland wrote a report for the UN in 1982 that was the precursor for all of this that we're talking about today. But that was 1982, and she spoke about gender equality, she spoke about climate change and so on. So clearly there was a long period of time where nobody really listened to that. And here we are today. I am the custodian of other people's money. I have a fiduciary responsibility to provide them with the best return. I do also feel I have a fiduciary responsibility to, when I give those monies back, that they are paid into a community or society that is sustainable. There is not very much point in achieving 10% every year and then pay it back into a society that's not livable, as opposed to something else. I think, though, we're very lucky right now that it is a sort of generational opportunity, if you want to use maybe a bit of a hype word, where you can match both your intentions around that subject and returns. You gave a fantastic presentation, Clara. It's focusing a lot on the public security side, whereas I think in the private field there's a lot to be done. So that's my sort of short take on what has it evolved, certainly, but that's more in terms of understanding. And you will notice that Clara used very little the expression of ESG. I think we're even moving past that in some parts of the investment community in Europe and in the US, frankly. So this is evolving, and it's evolving fast.
And
I pass it over to David.
Right, so we shall leave the best for last in terms of Clara then. So thanks, Wenyi, for the introduction, and very good to see everyone. I think as introduced, both Kim and I, we represent the investment side for the insurance assets. So I think I share very much of what he has said, but I think one thing that I would like to maybe supplement is with regards to the long-term objectives of the way we look at life assets in particular, right? I think this ESG or sustainable investments, there's a natural overlap, because we're not just looking at returns just for the next 3 to 5 years, but how do we deliver returns over the longer period of, say, 20 years or even more in some cases. So I think some of the examples around governance for investments, that's obviously always been there. In the way we look at credit, in the way we assess companies, we do need to make sure that it's going to be around, right, 20 years from now, if we're going to buy a 20-year credit. But I think increasingly, there's also a lot of, in the recent years, a lot of discussion around the environmental aspect, right? There has become, well, from something of a luxury to look at to something of an emergency, right? As we start to see the impact and the numbers look horrifying, right? Which we can touch on a little bit later on. And even for us, I mean, there's the part about, for income, we've always been founded as an organization to do social good, right? But I think it's also important to recognize that it's important to deliver the performances, both in terms of business as well as investments. And this is where it starts to become very real. in terms of environmental impact on our investments. You will see many of the asset owners, I think something that Clara said, started off with exclusionary, let's exclude all the coal companies, the dirty companies and so on. And it becomes very real because some of these assets can potentially become stranded assets, right? Something that nobody wants to buy. Then as an investor today, if I'm still holding on to it, what does that mean, right? So I think these are all very real questions that we are asking ourselves, not just that simple part of 2 to 3 years back, let's exclude, let's set net zero, but now is where really the hard work begins, right? Where are you going to put your money to make sure that it creates a positive impact that we are looking for, that alignment to our own company's SDG, which can vary, as you have seen in the previous presentation, right? So these are, I think, that process that we are going through right now. I like the portfolio optimization tool, Clara, that you shared earlier, clearly something that we can look at. But at the same time, we also recognize the lack of data, which I think was a question posed earlier on by the audience. That's always going to be a challenge, right? So I think we are in that journey. And I also start to see another aspect of the evolution, which is more conversations and more collaborations among the asset owners as well as the asset managers. Among our, I think more frequent conversations was also reaching out to our asset managers and say, look, how can we collaborate more in terms of engaging with companies on the things that are important to us and our policyholders? Right. So with that, Clara, why don't I pass it to you before I cover everything?
Yeah, I have nothing to say now. No, that's why I think it, there's different ways of thinking about sustainability investing, and I think some of the points that I think would be interesting to think through from a regulatory perspective. I think regulators are naturally very conscious of risk. So one way of thinking about sustainability investing is a lens or a tool to avoid taking on sustainability risk that will cause bad things to happen to your investment. I also can think about sustainability investing as a way of identifying opportunities. So as much as we want to do social good and being able to provide the capital to support the initiative that will generate good technology, good outcome in the future, there is also an investment angle to this conversation, which is at the same time, there are cases where you can generate a good return from also investing in these companies. And I think the third part of sustainability investing to me is really using the power to influence. I think that's a big part of that conversation. So as asset owners, we do have a lot of power. And it goes back to Dave's point about collaboration. If we can collaborate together and influence companies as asset owners, that's also a big part of creating change and supporting sustainable investing. Certainly there are more, we can also create tighter and stricter definition on sustainable investing depending on what you want to achieve. But I think in the broad kind of social conversation, these are kind of areas which are helpful and supportive to the broader conversation.
Thanks, Clara. I think this really nicely comes up to my next question. I think Kim talks about custodian of policyholders fund. I think really as custodian of policyholders fund, even from my perspective as appointed actuaries, is sustainable investment and a constraint. Are we doing the best for our policyholders? Are they achieving the best outcome if we incorporate sustainable investment strategy into our portfolio?
Yes. I mean, again, every investment decision, and I'm David backing up here, every investment decision starts with returns. But as Clara also showed in some of our portfolio models, the returns are often based on old modeling, right? If you invest in an asset that has 25 years of life, and that is a asset that may give you a fantastic return, but does not contribute to 2050 goals, there is a problem, right? So therefore, we will be penalized at some point of that asset value over the life of the asset itself. So I think this is where we have to come to a realization that whilst the way we measure things in terms of value today will change over time, I think we'll become a lot more cognizant of the fact that some of the valuations in these portfolios will change as a consequence of the intensity that arises around these subjects. And as David rightly said, the emergency of it. So therefore, I'm certainly not arrogant or ignorant to today's valuation methodologies or the way we look at the data that we receive from the various companies. I just think that will change over time and become quite more tilted towards the just transition process. That's one, because let's face it, on coal, how do we survive out here without coal in our part of the world? It's easy enough to sit in Europe and be sanctimonious and say you should stop, but it can't happen overnight. So we need to find some very smart transition methodologies around that. And I would also say that, and I hope at some point we can talk a little bit about the Tarman speech. It obviously requires some help from regulators to understand that, but also for them to understand possibly that the nature of an asset will change over the time of its life, and it will change dramatically as we go forward, because I think both our data sets will become much more transparent. Now, you use MSCI. MSCI is a fantastic company and a fantastic index. Most of the information from MSCI come from the company's own annual report. So there's a lot to be done. I know you have many other models at Robeco, and you have 20 scientists employed as well, which we certainly don't have, and kudos to you for having that. But there's a lot here that I think today's methodology certainly won't be applicable in 5 or 10 years' time. But we think a lot about what the asset does over that. And I actually personally think that the value of that portfolio that you showed, Clara, will increase more than the other one. So I think the returns will be much higher on the SDG or the transition portfolio that you showed than the other portfolio. So the answer is yes, but okay.
Okay, I would say, I think if we look at investments today, right, the two big topics that's going to be impacting our generation, right? Kim and I probably closer to the same generation than the younger ones, like among you, is that one is digitalization, right? And then the other bit is clearly sustainability. So whether you like it or not, how your returns will pan out, to me, these two are clearly very important drivers. Now, on the area of digitalization, particularly, I think the generative AI that everyone is talking about, that's very visible. You play with ChatGPT, you get excited about it, and you dream of all the possibilities, right? So clearly there is that alpha generation behind it, as you can see from NVIDIA and the likes. The other bit that I think in response to this question is sustainability. In my mind, is also a key piece, right? If you are looking at returns over the longer term. Now that, I think the challenges, which we have covered quite a few times, is therefore that linkage of forward-looking projection. How's that going to deliver me a positive or better outcome as a policy holder? I mean, I would also share from the income experience. We did, I think, in recent times, also launch ESG-linked type of products, right? More on the shorter-term space, green bonds, and the likes of that. And while we are talking about it, while you read it in the press, the short answer is there is very limited appetite among the common population with regards to this, simply because of their failure to link it directly to that outcome that we're talking about today, right? So that is the reality of it. But having said that, I think for us who believe in it, right, I think it's more therefore about integrating it into the way we look at the assets, how we actively pursue opportunities within sustainable investments in the belief that it's going to generate better returns as it becomes more mainstream. All right, so that's on the positive side. The other bit is also, I think, looking at it from the risk management perspective, right? How do I incorporate some of these sustainability criteria in order to mitigate the risk, right? One of which is stranded assets, as we talk about, as an example, or even the cost of carbon credits once it starts being part of that regulation in the near future, right? So those are, I think, that the two pieces that I will think about when I look at how we look at sustainability for the benefit of the policyholders. One on the positive alpha generation, but the other is also in terms of the downside, right? The potential risk that's coming up in the horizon.
I feel like I have also answered the question
Okay.
by accident, but I think we've demonstrated it is possible to generate a better return in portfolio construction. I think the only other thing I just want to also mention on the alpha generation, Robeco as a sustainability asset manager has been running investment strategy for a very long time with sustainability built into the process with tangible sustainability market, and we have been able to demonstrate via our historical track record some of the areas that David just highlighted, which is you can generate alpha and you can also demonstrate that risk has been reduced by looking at a sustainability portfolio. So that information evidence does already exist. As Kim also touched on, the biggest challenge in creating this is having that big information data and ability to delve into those information at a very detailed level to achieve that. So, but I mean, the question of achievability, the answer is yes. And also the question on what sustainability means for investment, you know, again, echoed what the others have said so far. It is part of defining the future going forward. So yeah, so I do see that as part of an investment thesis to incorporate sustainability by that definition.
I think I'll combine my last two questions together. I think from my perspective, as a Singapore actuary, I think we don't know much about what sustainability is. And we don't incorporate that. I mean, as an actuary, as a citizen, we don't incorporate that into our day-to-day lives, which is why David commented that, you know, you can offer some green bonds, but does it resonate with policyholders? I don't think it does not at this stage, because we don't know much about it. I think the last two questions I had is really what initiatives have been done or can be done to really drive positive outcome. Maybe Clara, you can share about some initiatives that you have seen in Europe and US.
Yeah, I mean, I think it's a very good point. The relatability question, which is what you touch on. I mean, it's all very well to say we should reduce carbon footprint on this strategy, or we incorporate an SDG in that strategy. But at the end of the day, you know, my mom and dad is not going to get it. They certainly not going to invest in it on that basis. I think it's important to communicate sustainable impact to the end client in a way that they can understand. So this is where I feel like areas like impact metrics will help support that argument. So, you know, if you say to somebody you're supporting SDG 7 in renewable energy, yes, that's nice. But if you can say to somebody, this is how many kilowatt you save by investing in this strategy, or this is how much water wastage you manage to avoid, or this is how many new loans that you can create to small, medium business. If you can translate actual investment strategy into a social impact that people can understand, then, and also link it to the return metrics, being able to demonstrate you're not giving up performance in going sustainability, I think that's more likely to create an understanding from the policyholder perspective to say, hey, I'm investing in a good strategy that generates good return, reduce risk. Oh, at the same time, here's the social good that I'm also doing, and I can choose to do that. That's the option that the insurers is giving to the end policyholder. And that's the kind of conversation we have been working with insurers in creating their long-term savings product, be it with profits or unit link and other forms of savings products.
And David, any points you want to make, especially from a social enterprise? I guess income is is always known for being a social enterprise, and how can we drive the right behavior?
Yeah, well, thanks for that. I was going to add the part to maybe expand a little bit more on the part where we talk about the just and inclusive transition, because that then touches on that inclusivity, right? I think the part about exclusion and negative screening, that was the earlier phase. I do recall in a recent dinner event, coincidentally, it was a question that was posed to our Minister Taman, right, about how do companies and their employees adapt to this sustainability push, right? So this was coming from a CEO of a medium-sized oil drilling company, right, a Singapore company, no less. And he says, okay, look, I have now been categorized as dirty. I want to learn to be green. I want to learn to be sustainability. I want to give my children a good future. But talk to me and tell me how to get it done, right? Because I want to do that as well, right? So I think this is a part where I think there's a clear, maybe a disconnect, I think, today, right, which has gotten better, but a disconnect between the sectors which are affected, right, and they want to transit, right? But I think how the financial community then impose, right, how we think the behavior should be like, as opposed to how do we engage them in order to improve their processes, how do they should be thinking about, or even sharing practices of some of the other companies that have successfully transitioned from the dirty energy over to a greener type of energy or processes. So this is the part where I do see a lot of initiatives that still needs to be done. It was a very good question, and to me, I mean, for me, looking at assets, it was a very sobering moment for me, because this is a real person with an employee of 100 people, right? Their lives are going to get impacted, right? So I think it's starting to seem like the convergence of this environmental and social and governance, it is going to come more and more closely together as we evaluate opportunities, and also how do we want to execute our sustainability initiatives. I think that's going to be quite important aspect of that.
I'm back online. I apologize. Clearly, my digital savvy is a reflection of my age, probably. But what I would say is also to that, David, there's an added for the SMEs. This is a very onerous task, right? It's a question of bandwidth. If you go to any of your banks here, they will not lend against it. So somebody has to step in there. I actually think that would be a role for someone like you and I, that we could, with some form of help from MAS as an obligor, at least a principal guarantee, maybe we can deploy some money there. And there's a lot you can do, but I would still want, of course, to protect my returns. But I also know that I'm taking a relatively, I know the risk I'm taking. So I think the question when he was about societal impact and social responsibility and so on, but as I think was stated also by Clara, I mean, these things are just emerging slowly, because there is this potential macro risk, as Simon calls it, rightly, that is just going to penetrate all aspects of society. So therefore, I fail to understand sometimes, to a certain extent, why we're still having this conversation. It's number one. Number two, I really do think that we're looking at it through lenses that were built 40, 50 years ago when we started looking at investments and returns and so on. Here's a risk we haven't really understood, or before we've never been asked to value. We will understand soon enough, and therefore our portfolios will shift, meaning there will be better returns. There's $2,500 of billions of dollars going in every year. There's a pretty good chance I'll get my money back with a good return. That's sort of how I see it, and I also understand that it will have an enormous societal impact. Incidentally, David, we also do the surveys, and we just finished one from 2,500 of our customers. And you're right, this does not rank very high. And to a certain extent, I don't care, because it didn't rank very high in the beginning, both in in Europe, even in Northern Europe. It didn't rank very high in Southern Europe. It still doesn't to some extent. And there are, as we all know, there are parts of the US where it doesn't feature at all, but it's coming, right? And I think Clara has nothing but transition products in 5 years' time to offer. I simply don't think you will have any other products. So it's a little bit the Steve Jobs conversation. The customer doesn't really know what he wants yet, right? But I do. And this will come. I think actually you will see, as we've seen elsewhere in the world, you will lose customers if you don't do this. So there's a commercial aspect for the PTE Limited that you are now as well at Income, and we will lose our customers if we don't do this going forward, because they will demand something from us. And by the way, before somebody says it's different in Singapore, I have to say I heard the same when I was living in Tokyo, in Shanghai, in Europe, and in New York. So I don't buy that one anymore. And I think I have proof of that.
So I think this comes very nicely to my last question. So I think personally that Singapore is way behind the curve in terms of comparing it to Europe, but on what we do. But is any comment on that? Any opinions around this?
Clara, you want to go first?
Yeah, sure. I don't necessarily think that's the case, actually. I mean, you know, certainly the sustainability conversation has gone on for longer in Europe. There's a longer trend, history, background behind it. That is a fact. But I think, you know, I've seen not just in Singapore, but within Asia, the speed at which everyone's engaging with sustainability is fast. The transit, you know, the questions that I get asked, the level of detail, the technicality, the in-depth grilling that I get, it's got it. If Europe is going here, I feel like Asia is catching up quickly on this. So I don't, you know, being behind, probably I don't think it's a lack of interest or initiative. The biggest struggle with Asia is sourcing the appropriate opportunities within the Asian region. I think that's the challenge. But it's not due to a lack of will. It's identifying the opportunity within a different market. So you know, I think, you know, at some point at the speed at which Asia is picking up and catching up on the chain, you know, there's scope for Asia to take over. You have to remember, EU has 27 nations to talk to when they want to create any change. You know, it takes time. Yeah, so that's my belief.
But I would say they have one grid that they can decide on between the 27 nations. They have a forum for it, and that's probably what we also need here in this part of the world. And listen, I think it is really important to understand the origin of this, at least in Northern Europe. This was in the 80s, and it was out of necessity. Necessity is a wonderful teacher, and it will come as that here as well. I will add one thing from an insurance perspective. We have engaged in a lot of sort of alternative or private investments in this space now over the past 12, 18 months. And we try and seek help from European pension funds, European insurers, and as to how we value this from a risk capital perspective. And it is clear that, especially amongst the European insurers, and we all know who we're talking about when we say we're talking about one of the biggest ones in Germany, and as they will use their own modeling, and then the regulator will accept that. And I'm not suggesting that that gives you a relief, but it does give you the fact that there is a understanding of that if you issue a loan for sustainable finance over the period of 10 years, the credit or the risk profile of that will change, of course, right, as they pay it down. Therefore, why should I apply the same risk capital on day one as I do in year 9? And in Europe, there's an acceptance of these models that will help us enormously as we try and allocate more money as needed towards these investments. So that's probably where there is a difference. But I would also just remind everyone that in terms of China is very much on the ball here, and from an engineering perspective, but and has the same benefit that Europe and the US have. The Inflation Reductionary Act in the US is a big game changer. Eisenhower put in the highways, this is at the same par level with that and transformational for the US. In Europe, we do investments where at some point, if you look through the obligors, you end up with a sovereign guaranteeing something. And if you peel those investments apart and you see that your risk is to a AAA sovereign, if you can commit or if you can explain that to a regulator, again, it would make a difference. So I think that needs to change. And why is it better for David and I, from a capital perspective, to buy a bond issued by Exxon than it is to help finance an offshore wind farm in Vietnam? There's something wrong there.
Yeah, just one thing I would add on to that is I do think Singapore as a financial center has a huge role to play, right? Because I do think like some of the examples that Kim has shared around Europe and China, there's a lot of capital there, right? It could be the government, right, who's funding some of these projects driven by regulations and fiscal budget. But across the developed and the emerging markets, especially on the emerging markets, there is a demand-supply imbalance today. A lot of the emerging markets today, they're transiting out of the coal as a main source of energy, but they lack the financing in order to do that. Whereas you have the capital, right, in more of the developing markets that can be channeled on that. Now, there is obviously that price discovery in terms of returns expectations and the risk behind that needs to happen. But clearly, I think we have the unique opportunity to then do some of that in that role. And I think Singapore in the past has done well on that. I've also seen the Eco-Prosperity conference when you were talking about, I think all these are in the right space to really drive and make sure there is the connection between where capital is and where capital should be allocated to.
Thanks so much. I think Andres, I think we are running out of time. I think now I'll open this to the audience if you have any questions for the panelists.
Correct. So to the audience, please type your questions into the box below, the Q&A box. Also, dear audience, please notice the link that the Secretariat of the SAS has provided earlier. That's the link to the YouTube video of Senior Minister Tharman Shanmugaratnam's speech earlier this month, which Wen Yi is highly recommending to everybody in this virtual conference. I'm trying to be conscious of time. Let's wait a few more seconds for questions to come in. In the meantime, let me ask a bit of a niche question, and we don't need everybody's view on this since we are running out of time. What about resilience bonds, and what about cat bonds where the collateral is not invested in government bonds but also in resilience projects? So they are talking about this, or have started talking about this recently. If the question was too silly, you can refuse to answer.
It's a complicated way of raising finance that could be done much easier otherwise. Is the way I see it.
Okay.
It doesn't give you more transparency, and you try and explain that to a financial advisor. That's a little bit difficult. It's difficult for me to understand to begin with.
Okay, so according to Kim, this is not something that's going to fly. Anybody else?
It's not a space that we look at quite frankly. I think it's been talked about, but I think just on the opportunity set, my personal opinion, it is fairly limited at this moment, and also the potential of it growing into more of a mainstream product. I think that is yet to be seen.
Okay, we haven't received any questions. Nevertheless, this was a very insightful panel.